Hello, and welcome back to our interview series on content for the federal workforce. Today we're talking about real estate, specifically in the DC metro area. My guest is Sara Rutledge of SRR Consulting. Sara, thanks for joining us.
Thank you for having me, Brian.
Let's start with sharing a little bit about your background and your firm, SRR Consulting.
Thank you. Of course, as you said, I'm Sara Rutledge. I'm also a counselor of real estate and founder and chief economist of SRR Consulting based here in Chicago. My background is all commercial real estate research. I've been in that business for 26 years. I've worked for real estate brokerage services, data providers, and investment managers. I began my career in Dallas and moved to Chicago 10 years ago to lead research for the National Council of Real Estate Investment Fiduciaries, and loved it so much I stayed here in Chicago and launched my business in 2018 to fill a gap in research services for small to mid-sized investors, offering the same custom research services that they would have with an in-house department. I also offer a Substack with weekly updates on key economic trends and more in-depth real estate coverage with a monthly research piece and quarterly investment performance, which is behind the paywall.
And that's how we came together. It's some great content. I appreciate you sharing it. So my audience is federal employees, and they're having a moment here. Lots of uncertainty and changes, specifically with the workforce and their jobs, but also their homes, which is one of their largest assets. So for those affected by the administration and those living in the broader DC metro area where we are, but any location you'd like to touch on, can you share how the administration is changing that economic outlook?
Yeah, and I'll start with the labor market because the US labor market in general has been very strong. We've seen strong job growth. The pace of job growth is slowing, 151,000 jobs added in February, but the unemployment rate at less than 4.5% since 2021 reflects the strongest US labor market since the 1960s. But all of this is at risk given actions by the new administration. And you're feeling this, especially in Washington, D.C. So as DOGE cancels funding and employment across government agencies despite congressional appropriations, that's going to impact the over 5 million federal workers that are based in every congressional district in this country. And funding for the work they do has a very high multiplier effect. So, if you can think about that as payments that are given to people in need, whether that's Social Security, SNAP, Medicare, Medicaid, those funds are fully spent. And so when those funds are spent in communities, it multiplies to grow the local economy. And when you pull these jobs and you pull these funds out of the economy is going to contract. And I like to look at the GDP Now estimate from the Atlanta Fed because they take the real-time information that comes in that will amount to GDP growth for the quarter. And they say, how is it trending within the quarter? So it's a current quarter estimate. And right now it's showing that first quarter 2025 will be a contraction of 1.8% versus economic growth of 2.4% in the last quarter of 2024. And so the impacts of these are clearly going to be felt more in DC, but the outlook is not good.
How are these changes impacting DC area, specifically the real estate market there?
So similar to the job loss not showing up in the unemployment rate, real estate impacts are limited so far. So I'll start with the commercial side. Investors are more cautious about Washington, D.C. in general, but some see the potential for vacancies from the GSA to, create new opportunities for development investment, like of a mixed use sort of a mixed use development rather than clean office space. And so I'm going to step back a little bit and talk about the GSA portfolio. The GSA portfolio has over 360 million square feet of space. That's across the country, and half of that is leased and half of it is owned. So the leases that have the ability to terminate early are spread across 548 cities. DC is the largest, but that's only 4 million square feet of commercial real estate, mostly office. The second largest market is Kansas City with 3 million square feet. So clearly, DC has an impact, but it is widespread. When we look at the GSA leases that do not have an early termination clause, which means it would be a high penalty, a high cost to cancel those leases, those are concentrated in DC. There are 17 million square feet of leases without these termination clauses. And the second market, sizable market with those leases is New York City at only 2 million. So there's a big risk of losing commercial tenancy in DC. And again, as I said, some investors and developers do see an opportunity there to turn that space into a more vibrant or mixed use type of community. But the ability to do so, in my opinion, will depend upon the labor market picture, right? So if you're losing jobs, it's kind of hard to create a new vibrant space. But another factor before I leave commercial is the CMBS exposure to GSA leases. So the debt exposure creates a risk for a destabilizing risk to the real estate market, because if a GSA lease is inside of a pool of debt, that entire pool loses value. And commercial real estate has gone through a large revaluation with higher interest rates. And so pushing further on that weakness would be an issue in the market. The housing market in DC has not yet shown signs of weakness. You are seeing some listing activity rising faster in the far out suburbs like Frederick and Charles counties in Maryland. But home buyers remain active in DC with pending contracts going up. So it's not yet there. It's kind of like in the unemployment rate, you're not seeing it because it's just going to take time to flow through. What is changing in the DC area housing market is price appreciation. You're seeing some softness in pricing month to month, even though prices are still up about 2% year over year.
And then, so with the housing market, there's often talk about the supply and then affordability. How are the changes that are currently happening? Will they help or harm those changes, the supply and the affordability?
So sorry to bring more bad news, but tariffs and immigration policy are significant negatives for the housing supply. First, construction cost. To make housing more affordable, we need to build more housing. And if we have to pay more to build it, that's not going to result in more affordable housing being built. It also caps how much new housing is built because it is at higher cost. And, the first round of tariffs from Trump and his first administration is still making housing more expensive than it was before 2016. So housing is not affordable today, and these policies, particularly tariffs, are not supportive of increasing supply or reducing cost. And then the other piece of this is immigration policy. So the construction industry is already shorthanded for all types of labor, subcontractors, electricians, everything. And in construction, there's actually a wage premium that's been built up to try and fill this gap. But if you look at the concentration of the construction workforce that is foreign born, in the nation, it's roughly 1/3. In the DC area, that figures 53%. And so that's all immigrants, documented, undocumented. And according to Pew Research, undocumented immigrants are most concentrated across all fields in construction. So the way that ICE is removing immigrants with or without documentation, the issues at the borders, it's causing a lot of fear, and it's keeping people at home. So the labor side of the equation for new construction is also under pressure, and that could raise costs for labor as well as slow the ability to construct new homes.
Okay, interesting. We'll follow that. And then we have inflation and interest rates that also affects housing, a lot of different factors. What are your forecasts there?
So in a word, higher. I'm expecting inflation to stay very sticky. Of course, the Fed's target for inflation is 2%, and in their last release of economic projections, even the Fed expects inflation to remain above that level through 2026. So with stickier inflation and with tariffs also potentially boosting inflation, interest rates are going to remain high. We're unlikely to see many rate cuts, if any at all, in 2025 because of the battle against inflation. And then also we've got the lock-in effect for homeowners who have a low mortgage rate, who wouldn't want to enter the market and sell their house and buy a new one unless they had to. So in the housing market, you've got less construction, higher mortgage rates, and there are homes being put on the market, but the supply and demand are pretty much in balance at a very low level. So price growth is unlikely to move. Much like the numbers I mentioned for the DC area home market, they're pretty flat, 2% year over year up, about 0.8% down over the month. So it's just kind of a stable, low level housing market.
Understood. Understood. All right. Well, appreciate it very much, Sarah. That was a lot of good information. We'll keep in touch to have you back as things progress. We appreciate you appearing. Can you tell us a little bit about your typical clientele and how they reach you?
Absolutely. So my clientele is typically investors or participants in the commercial real estate industry. I do a lot of strategy work and pitch book work for my clients. And the best way to reach out to me for that type of work would be my website is srrconsulting.org. Also, feel free to subscribe to my Substack, where I talk a bit about macroeconomics and real estate with my own personal voice. So we'll have fun there. That's Sarah's Fun Facts on Substack.
And Substack is basically an opportunity for people to establish and distribute quality content for those who are new to it. As for myself, my clientele is the federal workforce and anyone who has been affected financially by the current events. So if you would like to discuss that and how things may play out, we are offering a free consultation. We can build a retirement projection to make sure things will work out okay or make the best decisions we can. My contact information is on the screen. Do reach out and we'll do our best to help. Thank you for your time, and we'll be back with another interview shortly.
Brian Kuhn is a certified financial planner with 24 years experience in the industry. He's the author of Total Compensation, a practical guide to federal employee benefits, and the host of Federal Workforce Uncertainty.